Hello everyone, hope you're doing well. Welcome back to the Road to Retiring channel. Today we're going to be looking at WNS holdings. Now I mentioned on my most recent video towards the end that the market is super high at the moment. The S&P 500 has been absolutely flying and there's not many bargains available. So when looking for these, I've been trying to find certain stocks which are at a good place to buy now, because I don't want to buy stocks when they're overvalued. I want to make sure I'm getting in at the right prices. And WNS looks like it could potentially be one. I want to show you the things that stood out to me initially and why I investigated it. So as you can see, this is going back to 2014, but the price has, in general, had a nice consistent growth to it. And obviously there's been dips during the COVID crash and then further dips, but in general this is a nice upwards trend on the price, and it's at this support level now that it's hit before, so it could be a nice time to buy into it, where we could see some really nice growth in the future. So I thought this could be at a bargain now based on the graph, but we need to do a little bit more research. So I have a look at some other things. The analyst ratings, that's strong buy, interesting. 1 year price target, 37.1%, 37.31% return. Okay, this looks really nice. Look at the forecast. You can see the analysts are predicting, the minimum prediction is $86 for this time next year. Now this looks ambitious to me. But it's a really nice sign, and it's definitely one of the reasons I considered investigating it further. You can see that there's 9 analysts that have offered price forecasts, and they're all sitting between this $86 and $115 mark. So that is really exciting, as that would be a fantastic return for a year. And you can see there's 9 strong buys, 1 buy and 1 hold. So that looks great. Now, whenever I see something like this, these are the type of stocks that I'm interested in and want to have a look at further. So I thought, what's the risk like with this? What are their historic growth rates like? And you know that I like to look at a few different things to see that their growth is consistent and that their projections are good. The first of these is earnings. So looking at their earnings, it's grown really quite nicely from 2015. They had 1.92 earnings per share up to 2022. Now this is non-GAAP price over earnings, but still really nice growth. And this is we're going to use the non-GAAP price of earnings values because of this, but yeah, as I say, quite nice growth. 1.92 reported earnings in 2015 up to 3.86 in 2022, and it's projected to continue growing all the way to 5.61 in 2025. Now when I do my forecasts, I like to use a 5-year estimate, so only having the years up to 2025 isn't ideal. So that's when I jumped over to Yahoo Finance, and this is really nice to see. You can see the next 5 years, analysts estimate a 13.59% earnings growth over the next 5 years. So that to me is really exciting. And another exciting thing here is you can see July, 8 strong buy recommendations, 7 buy. Not one analyst saying that you should hold, underperform or sell it. They're all saying this is a good time to buy. So definitely worth investigating further. So when I look at this, I thought, okay, the earnings growth looks good, 13.59% expected in future years, and I like to see around a 10% level to think like, okay, this has some really nice competitive advantages and it's able to outperform the market. So 13.59%, that's really nice to see. But I also like to look at revenue, and we have a look at the revenue here. Again, really nice consistent upwards trend. 562 million in 2015 up to 1.16 billion in 2022, so almost doubling in those 7 years, and it's expected again to continue growing all the way to 1.65 billion in 2025. So again, really nice consistent growth there. Alongside the earnings and revenue, I like to look at the operational cash flow and their equity growth to check that these things are consistently growing as well. And if we have a look at the operational cash flow here, change it to annual, you can see it does seem to be falling, but this is because of the change in working capital. What we really want to look at, what drives this cash from operating activities, is the funds from operations, because you can see the change in working capital is the other thing that makes this up, and this is a lot more sporadic. It can be positive 15 million in 2019 and then negative the year before, negative again the year after. This can change from positives to negatives all the time. It's not really consistent, whereas the funds from operations are the things that really drive the cash from operating activities. And you can see that this, although it's not growing at a really fast rate since 2019 and it had quite an impressive year then, is still growing steadily from 95.3 million in 2016 up to current levels at 244 million. So that is still really nice growth rate, though obviously this has slowed down a little since 2019, only going up 30 million, but the growth is still there, and 2019 looks to be a little bit of an anomaly as it did fall off the year after. However, after the COVID crash, it has continued to recover and grow at quite a nice rate. So I think that shows really nice signs. And lastly, I like to look at the equity, and this is just super consistent, super nice, from 400 million in 2016 up pretty much year on year to current levels 801 million. So again, basically doubling in that period. So their historical growth rates look really, really nice with this company. So, alongside this, okay, I can see that they have those growth rates. I can see that they're holding some sort of competitive advantages to be able to grow each year. But what sort of decisions are the management making? Are they investing effectively? So let's have a look at their return on invested capital, which is sitting, again, I like to see around 10%. This is quarterly, but you can see consistently over that 10% mark. Minimum it hits is around 13%. And if we look annually, it was below that 10% level in 2016, but since 2017 it's consistently been above that 10% benchmark I like to look for. So this is really nice for the return on invested capital. And lastly, I want to look at the financial health of the company. I want to check they're not going to be in any trouble in the coming years because of debt, and this overview page is really useful for this. So if we jump down to the bottom here, you can see their financial health. Now in 2022, their debt did jump quite a bit. You can see there's quite a large jump in their debt. However, I like to see that a company can pay off their debt within 3 years of their free cash flow, and this is doable. This is something which WNS is still able to do. You can see 160 million in free cash flow. That can pay off that debt within 3 years, so I do still feel comfortable at these levels, but it is something I'm going to be keeping an eye on, because if that debt continues to climb and the free cash flow can no longer pay it off, I'll start to maybe increase my margin of safety and think, am I comfortable with this? Maybe I won't continue to buy if that debt does rise above a certain level. So it's definitely something to keep an eye on. If we jump over here to the financial position analysis, this looks very healthy. We can see assets in the short term they have around 200 million more, and in the long term they've got over double the long-term assets compared to their liabilities. So it doesn't look like their liabilities are going to cause them any problems in regards to their assets at the moment. They're easily able to pay off these liabilities if they have to sell some of their short-term assets to pay them off. So that to me looks really nice. It looks like it's in quite a good financial position right now. So I'm going to have quite a low margin of safety with this one and sit this at around the 10% mark. So now let's go into our values for it. Well, as I said, I've gone for this 10% margin of safety. I put a share dilution of -1% in because they have been buying back shares. You can see total common shares outstanding. Even quarterly, you can see this has fallen, but if we go annually, it's dropping off quite nicely at quite a good rate. From 2017 at 54 million, they bought back around 6 million shares to the current amount, which is, well, this isn't the current, they're 48.36, you can see that's 2022. Current, they've even dropped it another million since then. So yeah, buying them back at a really nice rate. So I put -1% share dilution, putting us at around 45 shares instead of 47.36 in 2028. Now they could easily buy back more than this, but we want to make sure we're on the safe side with it. I've gone for a 10% earnings growth rate. This feels really comfortable. The realistic growth rate based on their company's numbers is around 12%, and as I showed you earlier, that 5-year analyst estimate was sitting at 13.6. So even if they don't hit those levels that the analysts are expecting, they undershoot it to around 10%, because I want to make sure that we're being a little bit cautious with our predictions. And with a price over earnings multiple, I've gone for 17. Now typically, you can see they trade a little bit higher than this. Their 5-year average was 22.68 over the last 5 years. And if we look at the price over earnings here, and we move this to past 2010, you can see it never really has traded as low as 17. But again, I just want to be on the safe side. You can see this is always typically traded around 19 and above. But again, I'm being safe, I'm being cautious with my predictions. It's at the sector median level of 17.32, and typically, as I say, there's a little bit of a premium. So even though the sector's at quite a high level right now, I think if this does drop off to levels at 15, 14 when the market's not so high. That 17 still feels like reasonable at a nice level because there's typically a premium on this stock due to the high growth rates. So with that 17 price over earnings multiple, this gives us, I should say 2028 price here, but that gives us a price in 5 years of $125.23, and that means that the current fair value based on price over earnings is 71.6. So that's actually 4% higher than the current market price, showing that it's at a really nice price to potentially buy right now. But that's just the price over earnings. Let's have a look at the price over sales. I've gone for 10% revenue growth. This is pretty much in line with the expectations here. As you can see, from 2023, 1.33 billion expected, up to 1.65 billion in 2025. We've gone slightly under that, going to 1.6 billion in 2025. But that 10% mark, it feels safe, it feels consistent with the earnings growth rate we're predicting. And I've gone for a price to sales multiple of 2.5. Now this feels like quite a nice safe level, because if we look at how it's traded over like sort of the past 5 years, it's only really traded, the lowest it got to is 2.39 after the COVID crash. So that 2.5 mark feels quite safe, even though it's fallen off in recent years. The lowest it has traded in the last 5 years is around 2.39. So 2.5 feels like a nice safe level. And with that value, that gives us a fair value right now of $67.97. So it would need to drop by about 1% to be at that fair value that you should buy. But that's really close to the current market price again. So only a 1% drop. That feels quite nice to potentially get in at these prices. And again, this should say 2028 price, but $118.90 would be what it's worth in 2028 based on these predictions, and that would be a really nice return from levels at $68 right now. Lastly, I want to look at the price operational cash flow fair value. You can see I've gone for similar predictions to price over earnings, as a lot of it is driven by this. We've gone for an 11% growth rate because it tends to grow in line with earnings, but you've also got to consider things like depreciation and non-cash items adding on to this value. We've gone for the current values at 230, and we've gone for a multiple of 14. Again, this is kind of in line with the sector median. You can see a 14.5 is the current sector median, though WNS is usually at a little bit of a premium. So even if that sector median does drop off, I feel 14 feels like a nice level to keep that premium on the company. And I'm sorry about coughing, but I'm not too well at the moment. But if we check the fair value, we can see that would be a 68.87 fair value right now, with a 2028 price again of $120, and 47 cents. We take the average of all of these, and you can see the fair value based on this is $69.48, which is currently 1.26% above the current market price, meaning that it is potentially a buy now, and one that I think I am going to be adding to my portfolio today. Let me know if you think this is one that you're interested in, and if you think that this is at a good price, or if there's anything you think I should know about that maybe it's not so good a purchase and I should wait to see some certain things. Please let me know. But at these values, this would bring us, based on the current predictions for 2028, again this should also 2028, based on these predictions, this would give us a 12.11% return on our investment each year, which I think would be absolutely fantastic. So if you enjoyed this video, please do let me know. Drop a comment of any other stocks that you'd be interested in seeing me value. If you want to know what sort of predictions or values I think a stock will hit in the next 5 years, just tell me any stock in the comments down below and I'll take a look at it. But I really hope you enjoyed. Drop a like, subscribe if you want to see more content like this, and I'll catch you in the next one. Bye guys.